Okay, well, welcome again to How HSAs Can Save You Money webinar. Glad you all attended it. This is going to be an exciting webinar. As you can see from the screen, these are the different associations that we work with on employee benefits. I'm very interested in this topic of HSAs, and I'll tell you a little background. But first, I just want to let you know that on the right side of your screen, there is a box where you can ask questions. And so throughout the webinar, if you think of a question as we're going through this, just type it in. And then at the end of the webinar, I will answer all of your questions. Today, this topic is going to be primarily around how HSAs can save you money. This has been a topic that I've been interested in and training people on since the early 2000s. I've probably educated hundreds of people on the benefits of HSAs and how they can actually save you money. I work as a benefits employee consultant, and I've been working in that realm for about 8 years, and before that I worked with an insurance carrier, health insurance carrier, for about 7.5 years, where I learned a lot about HSAs. And the reason my goal is to make sure that you clearly understand this, and if you're an employer, that you would consider this as a part of your employee benefits portfolio for your employees. So our agenda is clearly, we want to understand what HSAs are, make sure that it's very crystal clear at the end of this and there's no confusion, reevaluate adding it to the your employer portfolio, and the biggest one of all is to actually save you money. So what is an HSA? An HSA is a tax-advantaged health savings account that's available to those who are enrolled in a qualified medical plan. It's completely owned by you, the individual. It's not tied to the employer, though it can be used as a vehicle through the employer and sponsored by the employer. It is not tied to the employer. It's not use it or lose it. We'll talk about why people think that it is. It's primarily a funding vehicle that can be used to pay for your qualified medical expenses. And I guess we're having a little bit of technical difficulties, so just bear with us. I think maybe the sound is going in and out. So if that's happening, just put something in the box there. So let's see here. So why HSAs? Well, and this is more of the philosophical reason behind them. They have been historically talked about alongside of high deductible health plans or consumer-driven health plans because they promote consumerism. And let me make sure I'm not going in and out here. Okay. The reason that they promote consumerism is because the main thing with an HSA account is that it's your money. And you'll hear that a lot tied with HSA accounts. They actually incentivize you to save because of the tax benefits. They decrease healthcare utilization because when it's your money, you're going to think about it more versus a traditional conventional health plan that may have very low copays to the doctors. And I'm sorry, just let me make sure I'm not going in and out here. Hold on one second. Let me see if I can resolve these technical difficulties. Okay, looks like we're good now. So Traditional conventional plans have very predictable co-payments. We'll talk about this. HSAs, it's your money, so then it's more of your choice, and so it does end up in the long run decreasing utilization and promoting creativity. So a lot of people, when they have these higher deductible HSA plans, they pair them with other creative benefits like telemedicine, where you could actually use a doctor over the phone for minor things like prescriptions or minor diagnostic questions, and that will not go towards your medical deductible. So the big idea behind these, the reason that they were created, is to help the overall cost of healthcare. And studies have shown, and we'll get into that in a second, that it's actually working. And that's why you'll find big corporations with thousands of employees highly incentivize their employees to utilize HSA accounts, or some large employers of 2,000 or 3,000 plus will actually make this the primary and only option for their employees. So here's what the data says. This was a very interesting recent study by the Devner Group, where they surveyed and got the data from 20 HSA providers in the country who hold an estimated 78% of all health savings accounts. And what the data said was that in 2006, when these were originally rolled out in the early 2000s, the assets in HSA accounts across the country was about 1.6 billion. By the end of 2015, the assets in HSA accounts across the country in these top 20 HSA providers is over $30 billion. So what does that tell you? That tells you that more people are able to save their money tax-free rather than exchange it for higher premiums, giving it to the insurance carrier. And I'll illustrate an exact example of this later. So let's just talk briefly about how it differs from other funding vehicles, because this can often be a point of confusion. It's not an FSA and it's not an HRA. FSAs are flexible spending accounts that are completely employer-sponsored. They allow you as an individual to project your medical expenses. So let's say you say, I think my medical expenses will be $1,000 or $2,000. You tell your employer, they get you set up with a flexible spending account, and then they deduct your money via payroll, and you're able to contribute to that throughout the year tax-free. Well, at the end of the year, if you over-projected, let's say you projected $2,000 and you only use $1,500, in most cases you lose that money and it does not roll back to the individual. It stays in the employer account. So a lot of people are very wary of HSAs because they say, I don't want to lose my money. HSAs, you will not lose your money. It's your own personal bank account. It's not an HRA. An HRA is more of an employer-sponsored account where the employer sets up a separate bank account and puts in a sum of money to help employees with very specific out-of-pocket medical expenses that are agreed upon in the HRA agreement. So for example, they may say, once you reach $1,000 of your deductible, we'll pay the additional $2,000 of that. And they can be set up in all sorts of ways. Both are employer-sponsored, very different than HSA accounts. So what are the tax advantages? Because that's a big part of the discussion with HSAs. They have a triple tax benefit, which means any money that you contribute to your HSA is 100% tax-free. Any interest that it earns is also tax-free. And besides the interest, there's some actual HSA banks that will allow you to invest a portion of your money into mutual funds once you reach a certain threshold, and that's all tax-free. So depending on your tax bracket, there's a 25 to 35% tax savings when you enroll in an HSA plan. You can contribute the money throughout the year, just normal deposits into the account on your own, or if it's done through an employer, it can actually go through payroll and be done pre-tax under a Section 125. There's no set rules on when or how much or there is on how much, but there's no set rules on when. So you can contribute all of the money at the beginning of the year. You can contribute it throughout the year. And then it's just a question of, are you going to take it off your taxes at the end of the year, or will you be taking it off your taxes pre-tax through payroll? So then how can you actually spend this money in your HSA account? What can it be used for? The IRS has created a list of what they call qualified medical expenses. And these qualified medical expenses include the common things you would think of, like copays or deductibles or prescription copays, but they also include a broader list where you can actually have dental expenses, vision expenses, even things not covered by insurance like LASIK eye surgery. That can be used from your HSA account or tobacco cessation programs. They also have a list on the IRS website or several other places you can find it, where you can actually find a list of things that are excluded. Because if you end up using your money out of your HSA account to pay for non-qualified medical expenses, you will incur a 20% early withdrawal penalty, plus you'll have to pay the income tax on that money. So it's very important that you pay attention to this, because it's not regulated on how you in other words, you're not going to get a debit card that restricts you from buying certain things. You'll be able to buy whatever you want with that debit card. So you have to make sure that you're using it for qualified medical expenses and saving your receipts in case you are to ever be audited by the IRS. One common question that people ask with HSAs is, can you use it to pay your medical premiums? In general, the answer is no, you cannot, but there are a few exceptions. If you're 65 or older, you can actually use this to pay Medicare or long-term care premiums. If you had an HSA and you move from one employer to another, or lose your coverage with your employer and you elect COBRA, you can actually use the money in your HSA account to pay for your COBRA premiums. Or if you're unemployed, you can actually use the money to pay for your health insurance premium if you are also receiving unemployment. You used to be able to do over-the-counter drugs. That has gone away completely with HSAs, unless your doctor gives you a very specific prescription for an over-the-counter drug, then it is acceptable under the IRS guidelines. So what are the contribution limits? Well, annually, they go up every year. In 2016, the contribution limit for an individual was $3,350, and for a family, it's $6,750. Now, family is defined as you just adding your spouse, or you just adding your child, or both. Any of those scenarios, you would be able to contribute the full max $6,550. If you're 55 years or older, you will actually be able to contribute an additional $1,000 catch-up amount as well. And you can do this from whenever you start and have a qualified plan in place all the way up to age 65. So if you've been contributing $3,000 to an HSA account for 10 years, you could have $30,000 in that account, and then the savings in that account would be anywhere from $7,500, the tax savings would be anywhere from $7,500 to $10,500 that you would have saved in taxes by utilizing an HSA account. Well, I've been mentioning that you have to have a qualified plan. So what is an actual qualified plan? Qualified plan, according to the IRS standards, and they're the ones that set the rules on this. And by the way, it's not very hard to figure out what a qualified plan is, because most insurance carriers will spell it out for you, and they will tell you very specifically that this plan is an HSA compatible or qualified plan. So this is more just behind the scenes information for you to know that the IRS says that the minimum deductible has to be $1,300, so it can't be less than that, and the out-of-pocket maximum for an individual cannot be any more than $6,550. The other thing that, and this is a very distinct difference between a conventional plan and an HSA qualified plan, is that you cannot have any copays before you meet your deductible. So what that means is that if you go to the doctor or the specialist or you get a prescription, all of that is going to be applying towards your $1,300 or whatever level of deductible you choose. So there's a little bit of different thinking in how you think about your medical expenses. You're still benefiting from the negotiated rate. You're not paying full price, but you are paying towards the deductible. So you got to be enrolled in the qualified plan. Other requirements are that you cannot be on a second plan that's a non-HSA qualified plan and also have an HSA plan. So you can't have two plans, one being an HSA qualified plan and another one being a rich copayment plan. You can't be enrolled in Medicare, TRICARE for life. This was an interesting one. You cannot have if you're VA, you can't have used your VA benefits in the past 3 years. But if you haven't used your VA benefits in the past 3 years, you can. You can't be claimed as a dependent on someone else's tax return. And you cannot be enrolled in another funding vehicle like an HRA or an FSA. However, there are exceptions to an FSA. So some employers have an FSA set up for just dependent care or dental expenses. If that's the case, you're able to still be enrolled in the FSA for your dependent care or dental expenses, but you can't have an FSA open for medical expenses and an HSA open for medical expenses. So those are kind of some basics behind HSA accounts. Now let's get to our big question of the day, which is, how do these actually save me money? Well, we talked about the tax savings, so that's number one. But number two is, and probably even more substantial, is that HSA plans, their premium is typically 15 to 25% lower than a conventional copay plan. So I wanted to give you a real live example. This is a quote that I did just a few weeks ago for a 22-person law firm. We quoted out both the conventional and an HSA qualified plan. The conventional plan had a $3,500 deductible, 80/20 cost sharing after that, up to their worst case scenario, their out-of-pocket maximum of $6,600. They had a $35 copay to the primary, $50 to the specialist, and then the doctor copays were $20, $50, and $75. Very predictable, what you would expect for prescription drug copays. The for an individual was $337.83, and for a family, $1,114.82, as you can see. The very similar HSA plan deductible of $3,500, 80/20, but the maximum is actually less at $6,450, had a premium of $267 for an individual or $881 for the family. Now the main difference is the HSA plan, even though it had the same deductible and the same or a lower out-of-pocket maximum, it just didn't have any copays. So the annual premium savings for that, though, for an individual was $847.92, or for a family on an annual basis, $2798.40. So significant savings, especially on the family side of things, for an HSA qualified plan. So then with that example, the question is, how do we know if an HSA is actually the right fit for me versus going on a conventional plan? Well, I generally have a simple formula that I use for worst case scenario. I will take the total premium, and everything you really need to do if you're going to determine this is annualize it. You take the total annual premium of what your HSA is going to cost you a year, total annual out-of-pocket expenses, and that's going to equal your worst case scenario for an individual. So take this example that we just did. I use this formula. The conventional plan, $10,653.96 is the worst case scenario. The annual premium plus the out-of-pocket maximum. On the HSA plan for this example, the worst case scenario is $9,656.04. So you can see it's about $1,000 savings even if you get into the worst case scenario. Best case scenario, you just end up saving on the premium, paying less for the HSA, $847.92, and then you get the 25 to 35% tax savings on that money that you save or any other money that you're able to contribute into the HSA plan as well. So it's very important to look at those different things and decide, well, what's the worst case scenario? Because a lot of people have this perception that HSAs are only good for healthy people, but they're actually a very good option for somebody that actually knows that they're going to have a large claim as well, because in this case, the worst case scenario comes out better. So how could you set this up? Let's say you're an employer and you say, well, you know, I'd love to put this in my portfolio for my employees. I'd love this to be an option for them, because you can do this. You can make this an option for them. Well, one of the things I would suggest, if you haven't talked about this or haven't had this as an option, and I've worked with employers on this before, is to have kind of a 2 to 3 year adoption plan where you slowly introduce the idea and you help people understand the benefits. And I can help you out with what that would look like. I've been doing this for employers for a long time. I highly suggest that you don't just move from a conventional plan and make your employees all go to an HSA plan. I've seen that happen. That's not very well received. However, with the 2 to 3 year adoption plan, what I have found is that most people will end up moving from the conventional plans to the HSA plans over time. Education is very key in this. They have to understand exactly what they're getting into. They have to understand the pros and the cons. And then picking the right insurance carrier is key, because different insurance carriers have different cost savings for their HSA plans. And so evaluating the market is very important on that. And then another, I don't know the exact statistics, but studies have shown that when employers contribute to the HSA plan, that employees are more likely to participate. So offering some sort of first-year incentive for employees to participate. What are the drawbacks? Because obviously I've presented this in a very positive way. I really don't think there are many drawbacks. I'll give you some drawbacks of some things that I have heard, and then you can evaluate them for yourself. Well, somebody might say, well, what if I sign up for this and I have a higher deductible plan and I have a big claim my first year, right when I sign up, before my HSA is fully funded. So that's a common fear. That fear can be overcome by understanding that you can fully fund your HSA account at any time, and also knowing that even when I showed you the conventional plan versus the HSA plan, both plans still had a high deductible, both plans still had an out-of-pocket maximum. And so in most cases, your employees are still going to be paying that out-of-pocket expense. The difference is they're going to be paying more premium to have a predictable plan where they can have copays to the doctors. So in a big claim scenario, it actually works out better if you have an HSA account, because then you can fund your HSA and get the tax benefit. The middle one is probably a very real one that I find, and this is why you don't want to just offer this as an option. It could be a cash flow problem for certain employees or individuals, and they say, you know what, I just like the fact of knowing that when I go to the doctor, it's going to be $25 or $35. Yeah, I know I could save over the long run, but I just like the predictability. And so for those individuals, that's why we have multiple different offerings. some people have said too, well, my deductible resets in January. What if I have a claim in the middle of the year and I have to, then my deductible resets? Well, it's the same scenario if you're on a conventional plan. You have a deductible, you have an out-of-pocket maximum. The positive is on this, you can actually fund your HSA account in advance. So let me just go over, before I get to your questions, and I will in a minute here, what are some commonly asked questions that have been received over the years for HSA accounts. So the first one is, well, I have this account, how do I actually spend the money? Do I have to get reimbursed for it? The answer is, it's your bank account, so just like a normal bank account would function, is how an HSA account functions. You get a debit card, you get checks, you can withdraw cash. Another question, what happens to my HSA money if I'm no longer enrolled in a qualified medical plan? So let's say you've been funding it for 3 years, you've been on a qualified plan, you have $5,000 built up into it. Now you go to another employer and they don't offer an HSA account. What happens to that money? Well, you can use the money, you can continue to use the money for qualified medical expenses. You just can no longer contribute unless you have a HSA qualified plan. So let's see what the next, how do I calculate my out-of-pocket RX cost to know how much I will be paying under an HSA qualified plan? Because this is a good question, right? Well, I'm used to paying a $25 copay, or I'm used to paying $35 or $10 for my prescriptions. How do I know what the actual cost is? Well, the insurance companies are making this more transparent, so there's a couple of ways that you can figure this out. You can go onto their website and actually see your claims. They'll actually give you a printout of your claims, or you can look at the actual negotiated rate. And when you look at the negotiated rate, that's about how much you can expect to spend, not the billed amount that the doctors bill, which is always 30 to 50% over what the insurance companies will allow, but the actual negotiated rate. And then you can have an idea what your monthly expenses will be so that you know how much you need to put in your HSA account. The next question, can I use HSA fund to pay for my dependent health expenses even if they are not enrolled on my plan? Yes, as long as they're not receiving another form of reimbursement for their medical expenses. Does an HSA qualified plan have a network of hospitals or physicians? Because this is another common question. Well, if I get to see my same doctors, the network is dependent on the insurance company you select. This is a full-blown major medical qualified plan. So just like a conventional plan would have a network of certain physicians and hospitals, it's the same principle for a high deductible qualified HSA plan. So you have the same network as you would. When can I contribute to my HSA account? I touched on this a little bit. You can contribute to it throughout the year, whenever you want, lump sum. What happens to my HSA if I pass away? Every HSA account at banks will ask you to list a qualified beneficiary, and that's where that money would go, similar to other investments. What if I don't pay medical expenses using my HSA account? So let's say you're just saving this money, you're getting the tax benefits, but then whenever you go to the doctors, you just pay out of your normal bank account. Well, with an HSA, as long as you keep your receipts, you can actually reimburse yourself later. So let's say you spent out of your pocket $3,000, but over the years you've just let your HSA account build up. Later on, as long as you save those receipts, you can reimburse yourself back from the HSA account tax-free. When can I withdraw the money with no penalties? Age 65. And if you do withdraw it at age 65 and you use it for non-qualified medical expenses, you won't have the early withdrawal 20% penalty, but you will just have to pay the normal income taxes on that money. However, if you use it to pay your Medicare premiums or just keep it in there for medical expenses, you won't be taxed. We touched on this. Can I invest my HSA funds? Yes. Certain banks will allow you to invest in mutual funds once you reach a certain threshold. The other one I mentioned on is that, yes, your employer can contribute to your HSA account, but the important point on this is whatever your employer contributes, that goes towards your maximum out of pocket, so, or your maximum contribution. So I think it's $33.50. I said was the contribution amount. If your employer contributes $1,350, you have $2,000 left that you can contribute into your HSA account. You cannot contribute beyond the maximum, no matter who's contributing. So with that, let me just see if I can address some of your questions. So just hang with me for a second here. So now would be the time, if you have any questions, to go ahead and type them in. And looks like we have a few already, so just bear with me. Actually, looks like we have quite a few. Okay, sound is going in and out, yep. Hopefully it's a little bit better now. The bank wants to charge a monthly administration fee per account, $4. Do all HSA administrators charge this monthly maintenance fee? No. I have some banking relationships that actually charge no fees. So it just depends on what you want with your HSA account. But if you're just looking for a bank that just to house the HSA account and you can have electronic access, there are banks that have no fees. Can an employer offer an HSA as a standalone benefit without a health care plan? No, HSAs would have to be paired with a qualified medical plan. Now, so if there's more to that question that I'm not answering, just retype it and I'll try to answer it. But as far as having an HSA account, you have to have a qualified medical plan in place. Is an HSA account the same as a medical savings account? Yeah, to tell you the truth, medical savings accounts were, I know, a big thing before HSA accounts. I don't know a lot about them. So to be honest with you, I don't have the specific answer to that one. I'm a solo member LLC. Can I set up an HSA? Yes. So an HSA can be set up for individuals or businesses. So anybody can set up an HSA account. The only prerequisite, along with some of those other ones I gave you, or the first main one, is you have to have a qualified health plan in place. If you have a qualified health plan in place, you can set up an HSA. Can we get a copy of the presentation slides? Yes, we record these webinars and they will be available on the website. Same question about the slides. I am 73 and am a managing member of an LLC. Can I benefit from an HSA account? If you're enrolled in Medicare, you cannot benefit from an HSA account if you're enrolled in either Medicare A or B. Now, I remember that if you're not enrolled in Medicare A and B, there may be the ability for you to benefit from an HSA account, but for the most part, generally the answer is no, you cannot benefit from an HSA account. Are you saying a family of one can contribute the family limit of $65.50? So the way that a family is defined is if it's just an employee or a husband and wife can be a family as far as the HSA rules are concerned. So if you just have a husband and wife on a qualified HSA plan, you can contribute $65.50. If you have a father and son on a HSA qualified plan, you can contribute $65.50, or a whole family. So any one of those scenarios, if there's anybody besides yourself on the plan, you can get the full $65.50 tax benefit. to clarify, copays will not apply towards the deductible with an HSA. Copays don't apply towards the deductible because there are no copays before the deductible with an HSA. But with the Affordable Care Act rules and the way that plans are set up now, everything that you spend out of your pocket that's covered by the insurance carrier, whether it's going towards your deductible or it'll all apply towards your out-of-pocket maximum. So that's where the worst case scenario comes in. As long as it's a covered expense and your insurance company is saying, okay, and let's say you have a $1,300 deductible and you spend $800 or $1,000, that's all applying towards your deductible, and that's also applying towards your out-of-pocket maximum. Okay, next question. My spouse and I have individual, not family plans. Can we both contribute the individual maximum of $3,350 each plus the $1,000 catch-up each for a total of $8,700? That's a good question. I might have to get back to you on that one. I've got your name in here, so I'll try to get back to you with an answer on that one. But I don't know the answer to that off the top of my head. That's a great question. What are the recommended HSA plans for a small employer? I'm not exactly sure what you're asking on what are the recommended HSA plans for a small employer. So maybe if you want to retype your question, I don't know if you're asking about carriers. There's all kinds of different carriers, and it depends on your size group and what type of a group you are to see what option would be right for you. If you're asking about which insurance carriers would be good, then that'd be a question that you might want to engage me with offline. And I don't think this was on the slide, or maybe it is, but no, my email address is jcleary@memberbenefits.com. I'll say that again, J Cleary, and it's spelled C-L-E-A-R-Y @memberbenefits.com, jcleary@memberbenefits.com, and you guys are welcome to email me or ask me any questions. My phone number is also 904-861-3235, 904-861-3235. Okay, we've got several more questions here. Can you direct us to the definition of an HDHP and specifically where copays are not allowed? So the definition of a high deductible, HDHP stands for high deductible health plan. The definition, oh, let me just finish your question here. I'm looking at IRS publication 960, and it says an HDHP has a maximum limit and out-of-pocket expenses which include copayments and other amounts but do not include premiums. So yeah, I mean, I know I'll have to find the exact source. There's many sources online that say this, and it's very clear that you cannot have copays before the deductible. And if you look at all of the plans offered by insurance carriers, you can't. Now, maybe there's certain copays that can apply after the deductible, and I have seen HSA plans set up that way where once you meet your $1,300 minimum IRS deductible, that they will let you have copays after that. So that may be what the IRS publication is referring to, but maybe we can talk offline about that. But every plan that I've ever seen, there's no copays before the deductible. May HSAs be used for health club fees? I think I read that on the expenses, and that is a exclusion. So that is not a qualified. Now don't quote me on that. Go to the IRS expenses, but I'm fairly confident that that is not a qualified expense for health club fees. Upon death, if it goes to a qualified beneficiary, will they have to pay taxes on it? That's another great question. The question in my mind would be, could they roll that money into their HSA account if they have one. I don't know the answer to that, but if it were just a distribution to them and then they use the money, I don't know the answer to that, so I'll have to get back to you on that. These are great questions. Can I contribute directly to my HSA account, or does it have to come through a payroll deduction? Either one. And if it's able to be set up through a payroll deduction at your employer, you can do that before taxes, but you're able to do either way. Is a service dog care an eligible expense? I don't know that, but one of the things that we can do is we can actually post a link out on the site for eligible expenses so you guys can have the full list of everything. Do we get credit as a Florida Bar member for this webinar? Unfortunately, we're not doing this for any CLE credits. Do you offer a webinar about an FSA account? We have not done one yet, but I was actually going to mention that when we were at that slide, that could be a future webinar that we could do for FSA accounts. If you want to engage me individually after this, feel free to ask me any questions, and we can help you get set up for that. Can a spouse use the HSA to pay their copay amount on another health plan? Can a spouse use the HSA to pay their copay amount on another health plan? So if you're enrolled in it, let's say you're enrolled in an HSA qualified plan, you're contributing money to your plan, and then your spouse is on a traditional conventional copayment plan. The answer is yes, you can use the money from the HSA account to pay for copays from your spouse's plan. Can my spouse pay for my qualified medical expenses from her HSA? Similar question. Yes, as long as you're not receiving some other form of reimbursement. If I set up an HSA in my personal name, can I also set up an HSA in my business name? No, the HSA is tied to you personally, but you can have your business contribute into your HSA account, and a lot of people do that, and that's very easy to do. But the answer is no, you can't have two separate accounts. It's per the individual and per the qualified plan that you're in. What are the limitations as far as cosmetic procedures are concerned? I remember reading this just the other day, and I'm 90% sure that cosmetic procedures are for the most part excluded as an HSA expense. But again, that's where that link to the eligible expenses will help you guys. What about if I'm covered by my wife's company plan, but I am a solo, I guess that's solo. Can I set up a family HSA? Covered by my wife's company plan, so you can't have two plans. So if your wife's company plan is an HSA plan, then you can, as long as you have two HSA qualified plans, but you can still only contribute the maximum. If your wife's plan is not an HSA qualified plan, then you cannot set up an HSA, or you have an HSA and she has another plan that you're on that's not HSA compatible. What happens after you pay your max deductible and out-of-pocket maximum when you have 20% coinsurance? So it's a good question just about the structure of the plan. So typically you're going to have a deductible, then you'll have 80-20. So let's say your deductible is $1,300 and your out-of-pocket maximum is $5,000. Once you reach your deductible of $1,300, you pay 20% of the difference up to $5,000, which will also include the $1,300 that you already paid. So type another question if that doesn't make sense. But your out-of-pocket maximum does include your deductible. It includes the 20% coinsurance that you pay. It includes anything now because of the Affordable Care Act. What if you're under VA healthcare program? So the VA mentioned earlier is the rule on that is if you have not used your VA benefits for 3 years, then you're eligible for an HSA account. If you have used your VA benefits within the last 3 years, then you're not eligible to open up an HSA account. I'm a solo practitioner, age 60. Any particular pros or cons for someone 5 years out for Medicare eligibility? I would just say, if you could, you would want to max out the account until you turn 65, because then you could use the account for other creative ways that you couldn't before you turn 65. But again, the same formula works out. Your total premium, total out-of-pocket expenses, and then it's just, you know, a personal choice of if you're okay with, you know, the higher deductibles. But I think at any age it's fine. I would just want to contribute the max if I could at that point. Do you know what the 2017 max contribution will be? Not off the top of my head. We can post that. I can tell you if you just Google it, it's going to be readily available or on the IRS site. But usually it goes up by like $100 or $50 or $100. So it's not a huge substantial difference, but it's going to be in the neighborhood of the amounts that I showed you. Are there program doctors and facilities? Are there program doctors and facilities since there is no copay? So I don't know if this is the question about the network, but you still have access to the same, whichever carrier you go with, you have access to their doctors and hospitals. Even if there's no copays, you would just go to their office and pay the negotiated fee. So they're still under contract with your particular insurance carrier. So if your insurance carrier says for an office visit, the contract is $80, then that's the amount you're working off of. No matter if they decide they want to charge $150 or $100, you're still benefiting from the negotiated rate, even though you don't have predictable copayments. These are all very great questions. If I have a traditional plan and my daughter has a plan through her employer, which has an HSA, can she still use my insurance? If she has an HSA qualified plan through her employer, and then she's on your plan, maybe that's the question. Let me just make sure. If I have a traditional plan and my daughter has a plan through her employer, which has an HSA, can she still use my insurance? So I don't know if the question is she's on both insurances, like she's on your traditional plan, but then she's also on her employer's plan. That's a HSA qualified plan. If it's an HSA qualified plan at her employer and she's not contributing to the HSA account, she can still use your plan either way. She just can't contribute to the HSA account because she's on a more conventional plan through you. So just write back if I haven't answered that properly, if there's more clarification you want to make to that question. Could I reimburse myself for medical expenses incurred before the HSA was set up? No. You would have to actually have the money in the HSA account, and then you could reimburse yourself from that later. I'm assuming you're maybe saying you're on a qualified plan, but you haven't contributed money into your HSA account. So I think the answer would be you would still have needed to contribute money into your HSA account to be reimbursed. But there may be more to that, so if you want to engage me later, we can talk about your particular situation. Could the HSA funds be used by a beneficiary for final expenses after a person passes? That is a great question. I don't know the answer to that, but we'll get the answer and we'll put it out there for you. Yes, individual is 34. So I guess somebody's already looked at the individual maximum has gone up to $3,400 for next year. So about a $50 increase. no change in the family. Okay. Will there be a replay of this webinar to be posted? Specific website address. You can go to memberbenefits.com and then click on your specific association that you're a part of, and we will post the webinar out there for you. Can I contribute the 2017 max contribution in December 2016, or do I have to wait for 2017? So in 2000, you have to wait until 2016. You can contribute the maximum amount all the way up till the end of the year in 2016, but for 2017 you would have to wait until that plan year. Wow, those were some great questions, a lot of questions. If you have any more, we have a couple minutes, or anybody wants to clarify some that they may not have thought they got a sufficient answer. But just thank you guys for being very engaged on this webinar. And again, I'd love to help you out personally if there's any way that I can. jcleary@memberbenefits.com, or my phone number 904-861-3235. But thank you so much. I'll give it maybe one more minute for a couple more questions, and then we'll close out the webinar.